warm? Do I want to jump in? Do I not want to jump in? We're going to give you a taste of that water tonight, because guess what? One of these faces that you're seeing here right now, that you're gonna have to definitely go February to see in person. You have an opportunity to taste one of these beasts tonight. I'm gonna drop the link for you guys, each and every one of you, to get in the room with these people. There is an early bird special, like everything else. There is an early bird special that you guys need to get in by Thursday, November 25th is the early bird special for the prize. So you definitely need to get in the room and get into this. Now, with that being said, are you guys ready to get a taste of the water? Because guess what? She's about to share with you guys different types of insurance and what a lot of people think they know, but they really don't know. They think they know. Listen carefully. They think they know, but they really don't know. So she's going to give you guys some spotlight about it. But before I bring her on, let me tell you a little bit about her. She's been in the hospitality industry just like me for 20 plus years. 20 plus years. And she saw the vision in this company. And guess what? She forget about the hospitality industry and been with this company for 4+ years. Not just that she's been with the company 4+ years, she's also a professor for 2 major colleges in New York City, guys. That's huge. That's huge. I had the opportunity to work with this young lady for 10+ years. It was amazing. That's how come I got into this industry with her. And, you know, it's amazing. Do you know how many families she helped, how many people she touched in the past 4 years? Already got her WFG watch, already got her WFG ring, already got her WFG plaque. And guess what? Homegirl is going for $250,000. How many of you guys can say, you know what? Dang, I can make that. Make it weird. Uncle Sam got to get paid. So you're not making that. I'm sorry, guys, but that's pretty much what it is. Okay, I talk enough. She have a lot of things to go through with you guys tonight. Without further ado, let me present to you the beast from the East. That's what we call her. This is what this company called this girl, the beast from the East. Without further ado, Miss Odetta King is all yours. Go, girl.
Thank you so much, Usha. Welcome, everyone. Hey, Julie and Aaron. Hey, Carlos. I see a lot of you beautiful people. I have a lot of amazing content to present tonight. I'm super excited. I love WFG. So with that being said, my portion, like Usha said, is really going to be sharing information about life insurance, right? And I tell people, whether you have life insurance or not, just come on and learn, because 9 out of 10 times what you think you have, most people, when you ask them what type of life insurance they have, they'll tell you, I'm not sure, I don't know. All they know, they have something, they're protected, and they're paying every month, right? So we're going to go over all the different types of life insurance. And guys, if you had asked me 4 years ago or told me you need to get life insurance, I would be like, hell no, I'm okay. I'm single. I ain't got no kids. I got my burial money. That would have been my answer. I got my burial money. I ain't got no kids. I'm okay. No, right? Single people need life insurance too. So a couple of disclaimer, this information I'm about to share should not be interpreted as accounting, investment, tax advice. This is purely for education, right? We're on a mission to financially educate 30 million people. Welcome to our workshop. We host these every Wednesday, right? 8 p.m. Tonight, you're going to learn the X-curve concept, right? And this always happens to me. Okay. Why proper protection is a foundation of your financial house. The value of property protection, right? how this benefits your overall financial strategy, and what are some common questions and mistakes. So just like with everything else, right? When you're building a house, you start from the bottom up. You got to get that foundation. So that foundation is proper protection. That's your health insurance, disability insurance, life insurance, right? You got to get these insurance. And so many people forget that and they go straight to investing or saving or something else. But this is really your foundation. Proper protection is your foundation to your financial house, right? You have to be, this is why everybody needs life insurance. Everybody needs health insurance, right? You need these things. Then the next thing you want to tackle is your debt, right? The third layer of your financial foundation is getting your emergency fund. Listen, we used to say 3 to 6 months, but COVID has taught us we need more than 6 months. And then the top layer now is investment, right? So let's talk about the X curve. What is this X curve concept? Well, when we are young, right, we have a lot of responsibilities. This is so annoying. When we're young, we have a lot of responsibilities, but we don't make a lot of money, right? We don't make a lot of money when we're young. Okay. Sorry guys, I'm having technical difficulties. So when we're young, we have a lot of responsibilities. We have the kids, we have mortgage, we have education savings for the college, and we also got a lot of debt, right? So the younger you are, a lot of debt, but you don't make a lot of money. Now, as you get older, the idea is the kids are gone, your house is paid off, and now you've accumulated wealth. So the older we are, we should have more of these things, wealth, as opposed to, liabilities. So that's pretty much the X concept. The older you are, all of your debt should be gone. The kids are off to college, right? And you should have accumulated a lot of wealth. So this is why life insurance is the cornerstone, right, for your financial foundation. Because when you're young, you got the kids that's under 18. You got the mortgage, right? Or you got the rent. So this is why you need life insurance to protect those things, God forbid, if something happened to you, right? Because again, the X curve is the younger we are, we need more protection to offset all of these things that we have going on. And the older we are, the kids are gone, hopefully the mortgage is paid off or about to be paid off. So moving along, what are some things that most of us insure? Car insurance. If you drive a car, you absolutely need car insurance, right? You also have some of us, we insure cell phones, right? We insure jewelry. Of course, we have to have health insurance. We have to have the mortgage insurance. Some of us have pet insurance. There's all kind of insurance, but what else? What are we missing in all of this? These are all things we're protecting. But what about the person who's going to work every day to pay for these things, right? We're protecting the car, we're protecting our health, we're protecting the cell phones or any tech gadget, but who's protecting you, right? So we insure these things, but we forget to insure the most important person who is paying to protect or who owns those things. So here's a quick letter. I normally, it's a life insurance policy letter. It says, you and I have similar purposes, right? You and I have similar purposes in this world. It's your job to provide food, clothing, shelter, schooling, medicine, and other things for the ones you love. You do this while I'm kept in a safe place. You have faith and trust in you. I have faith and trust in you. Out of your earnings will come the cost of my upkeep. At times, I may appear insignificant to you, but someday, who knows when, you and I will trade places. When you are laid to rest, I will come alive. This is your insurance letter. When you're laid to rest, I will come alive and do your job. I may provide food, clothing, shelter, schooling, medicine, and other things your family continue to need, just as you are providing now. When your work and labor are done, mine will begin. Through me, your hands can carry on. So we need life insurance, right? Because at some point we're all gonna die. And I don't know if it's because I do this business, I'm very okay with talking about debt, right? Because my affairs are in order. So other purposes, right? Life insurance can help with charities if you want to donate to a particular cause. It can help with your estate preservation. So many of us, sometimes we die and we may leave a house, but you figure, the kids now have to pay to keep this house, or they have to pay the mortgage, or they have to pay the tax. If you really want to truly build wealth, the rich people, they also leave extra money to keep these things for a generation to come. You just don't give your child a house and say, hey, you figure it out, because what we've seen is that the kids are selling it because they need money, right? It could also help with business planning and creating a wealth. So let's talk about, in keeping with time, how are premiums calculated when it comes to life insurance. So the younger you are, and I hate when people say, oh, I'll do it next week, next month, next year. No, life insurance is one of those things you want to buy it when you are young. I remember telling a pastor, hey, let's get some policies on your kids. And he's like, oh no, Dada, this is like morbid. I can't take out a policy on my kids. The rich people do. And if you know what we know, the minute your baby is born, 15 days old, and they got that social, you want to put a policy on them so you could make them a millionaire baby, right? So life insurance is calculated, or the premium is calculated by your age, right? The younger you are, the cheaper it is. Also your weight, believe it or not, right? You can't be too tall and skinny or too short and fat. Your weight also is factored in. If you have any health issues, past or present. I've had people who had, illnesses in the past, and depending on how recent it was, they may not be eligible, right? So if I say right now, you are healthy, you're young, your age is, your weight is good, let's get in touch so we could help you get something in place. Any medications you're on, all of these things will affect the cost of your insurance, right? Of course, if you're a smoker, we already know smoking is not good. So if you're a smoker, that's also going to increase your costs. What about any family health history? Yes, because there's a correlation. If it's in your bloodline, it may show up in your line, right? And driving records. If you're getting a lot of ticket and accident, you are reckless. So of course, that's going to increase your premium. And any high risk activities, if you love scuba diving, jumping out of a plane, auto racing or skydiving, like anything risky, all of those are factored into the cost of your insurance. So the earlier you apply for this is better, right? So which items are not factored into the rate? Well, this was supposed to be a quiz, but we're going to skip through it in keeping with time. So how do you calculate life insurance? There's something called the DIME method. And D stands for debt. How much debt do you have? I stands for income. You want to account for at least 10 years worth of income. If you have a mortgage, what is the balance on your mortgage, right? And if you have young kids and you want to make sure they go off to college, these are all things that you factored into to get you the total that you should be protected for. Now, there's two types of life insurance, and we're going to dissect into this. So if you have one of these, pay attention. There's two types. You have term and you have permanent, or what most people know as whole life. The main difference between term and permanent is something called cash value, or cash accruing in the account. Now, let's look at a term. Term is the most simplest form of life insurance. It's like renting an apartment. You pay for it, you have it. You don't pay for it, you don't have it, right? So you could have a 1-year term, you could have a 5-year term, you could have a 10-year, 20-year. Whenever that term ends, your policy ends. So if you take out a 20-year term, and now when you took it out when you were 40 and it's for 20 and now you're 60, at 60 you're uninsured, you ain't got nothing, right? So we're not passing down any generational wealth. Or if you live beyond the 20 year and you only took out 20 year and you live beyond, well, you ain't got nothing, right? Nothing. And all the money you paid is gone, right? So that's term insurance. It is only for a specific number of years. Now ask yourself this question. Do you guys think you should be insured for a certain number of years or forever until you die? The second form of insurance is what we call group term, or this could be your job insurance, right? It's usually 1 to 3 times your salary, right? Everybody gets approved because everybody worked for the company, whether you got diabetes, whether you got cancer, high blood pressure, overweight, everybody gets approved because you're under the umbrella of the job, right? So again, it's between 1 to 3 times your salary. It really doesn't cost you anything much. And some employers actually give it, some employers actually give it for free, right? But watch out. The insurance provided by your employer may terminate when you leave. And I spoke to someone today who told me they had a life insurance with their job, but guess what? Now he's an entrepreneur. Now he's self-employed. He no longer works for that company. So guess what? He no longer is covered because it's a job insurance, right? So a lot of you may say, Odetta, I have insurance and I want to ask you what type. If you tell me I got a job insurance, homeboy, girlfriend, you need to call me, okay? Now, the other type insurance is what's known as accidental death and dismemberment. This is super inexpensive, and in my opinion, or in the life insurance industry, it's really not the best value unless God tells you that you're gonna die by way of accident, right? Then you could get it, but nobody knows how they're gonna die. You could die peacefully in your sleep, right? You could die because of an illness, right? Heart attack, cancer, stroke, whatever, right? So accidental only pays out, right, if you had an accident or you had some dismemberment, right? So certain conditions must be met, and they're very, very, very specific before they pay out that money. So this is really not a good value, like I said, because nobody knows how they're gonna die. So I'm helping a client right now as we speak who reached out to me and she said, I have insurance. And I said, great, what type? Right? So when somebody tell you they have insurance, great. What type? Is the type that matters, right? So she said accidental. Immediately, I'm like, girl, we need to talk. Let's get you something better. Because did God tell you last night you're gonna die by accident? That's the only way you should get it. And even then, it's still not the best value. So here are some examples of how cost effective a term is. A typical $500,000, right? 500K for a 20-year level could be about $400 a year, right? Cumulative to $8,000. But guys, what most people don't know is once that 20-year term ends, the price goes up incredibly, right? So the first 20 years is about $400 a year, cumulative $8,000. But once that 20-year ends, now it's $2,000.25. And I've had policies where people did not even know that their insurance is going to increase in a matter of couple of years. So this is why, again, I'm telling you, all of you guys that have your license, new upcoming agents, when somebody tells you I got insurance, what's the question you're going to ask? What type? And get a copy of that policy so we can review it and we can do a complimentary policy review to really take a look, because you will not know what to look for, or you will not know what's the best because you don't know what else is out there, right? So here are some advantages and disadvantages. With a term insurance, it is super cost effective. You could get a lot of coverage for very little money, right? Low cost, very inexpensive, and you could get a lot of coverage. But I caution you guys, it's only for a specific number of time. You're only covered for a certain number of time, right? So 20 years, 30 years, 10 years, 15 years. So annoying. Okay, you're only insured for a certain specific number of time. The policy will lapse because, again, if you took out a 30-year, at some point that 30-year is going to come, right? And the policy will lapse, and any premium that you paid in, you don't generally get it back. So the policy will lapse also if you miss a premium. So you insure for $500,000, but if life happens like right now with COVID and you cannot afford to make your payment and you miss a payment, that's it. Your policy's done. It's lapsed, right? They're going to send you a nice letter telling you you're no longer covered, right? And you should know because you haven't paid it, right? So the premium at that point is wasted. Whatever you paid, and if you had it for 2 or 3 years, 5 years, 10 years, and you missed the payment, all of that is wasted. You cannot afford to miss any premium when you have a term. Now, what if you outlive the term? Let's say you took it out for 30 years. Right now, I'm helping another client. She took out her policy when she had no kids, no husband, no mortgage. She was in her 20s. And guess what? Now she has a kid. Now she has a mortgage and she's married. So guess what? Her 30 years is going to come and go. So all of that money is going to be wasted. Premium is wasted if you don't die within the term. So look at it this way. If you take out a term, you're pretty much betting on yourself that you're going to die within the term. That's the only way your family is going to see that $500,000. If you outlive the 30 years or whatever term, 20, 5, 15, whatever, if you live beyond that, that money is wasted. You can't get it back, honey. You can't get it back. That's how term is. That's how term is, right? And then, of course, becoming uninsurable forces you to renew the higher rate. Because if you took out a term when you were 20 and 30 year pass and now you're 50, come on, they're never going to give you the rate for a 50-year-old when you could have had a whole life or a better policy that you had initially taken out when you were 20 years old. So the older we are, this is why when people say, oh, I'll wait next week, next month. No. The older you get, it's going to increase, right? The policy cannot be renewed cannot be renewed beyond a maximum age. So this is why, again, with life insurance, you want to lock it in while you're young, right? And while you're healthy. So if God forbid something happened 20, 30, 40, 50 years down the road, you're still insured and you're still covered. Now, there's also a permanent solution because term is temporary and only for a specific number of years. You may live longer than your term. So what do? This is where now you have permanent solution. How long do you think you're going to live? Everybody would like to say, in the 90s and 100 or 80 something, right? We want to live long. So that's why we want to make sure that we have something that's going to carry us through all the years. So think about how much debt, loans, mortgage, or other financial burdens can pass on to your loved ones. Guys, when I see GoFundMe, I'm so livid because when someone dies today, the GoFundMe money 9 out of 10 times is just paying for the funeral costs. But what about the kids that they leave behind? What about the financial burden that they leave behind? What about the rent? What about the mortgage? What about paying bills to send their kids to school? What about all those other things? That still has to go on. So who's going to pay for those things now? Who's going to pay for it? When all we had was money to bury you, the problem still is there, right? The problem is still there, guys. So if term insurance is like renting an apartment, permanent insurance is owning. And guys, you always want to own. Ownership is always better than renting, right? So this is why I'm a big advocacy for permanent life insurance. Now, don't get me wrong. You could have term, you could have blended, you could have a couple, right? But just know that the term is going to end at some point. And if you truly want to build generational wealth and leave money for generations to come, a term may not do it, depending on when you die, right? So let's look at some permanent. Now that we understand term is temporary, now that we know job insurance, right, is only covering you while you're with the job, and now that we know accidental is only covering you in cases of accident, death, or dismemberment, let's look now at a whole life, permanent insurance, right? So the choices of permanent insurance are whole life, and then you have universal life. So with a whole life, universal, and index, what do they have in common? Well, whole life builds cash value, right? You're going to have some cash value grown in the account. You could have a fixed premium, whole life, which means your premium stays the same forever. If you're paying $100, $60, $200, it's going to stay, the premium is always going to be the same. It's fixed, right? Whole life insurance is a policy you keep your whole life. You own it. Now, here's an example of a whole life. And again, because of time, we're zooming through this. So this is why you definitely want to get in touch with the person who invited you on this webinar tonight. And those of you that are watching on Facebook, also make sure you get in touch with us. A typical whole life insurance policy has fixed premium for, this is for a fixed premium for a 30-year-old non-smoker. Now, 20 years into the policy, their cash value is about $60,000. Their guaranteed contract, sixth premium that they've paid in is $64,000, but the cash value that built up in the account is $60,000. So really not bad, right? For, at least you have some money coming back to you and you're covered for your whole life. Whereas a term, if you had a 20-year term, you ain't got nothing coming back to you. You won't have no cash value, right? Now, 35 years in, you put in $113,190 and your cash is $156. So whole life is good, but guys, we're about to show you better, right? So whole life, you have some cash value building up, you're covered for your whole life. That's great. Now, there's also final expense. What is final expense? Final expense is a type of whole life that is used mainly for funeral costs. There's some older people in their 70s, 80s. They don't care about the cash value. They just want some protection for funeral coverage or funeral expense, right? So this is your final expense. It benefit usually issued sooner than traditional life insurance. There may be some other benefits. We work with several companies, and one that we work with really, really close is called IA America. It's more than a whole life. You have concierge service, you have estate planning, all built into it. So again, final expense is another good policy that, sometimes that we offer to clients. Additionally, for people who may not qualify for regular life insurance, this is also something that they could apply for. Underwriting is less strict. If you have some medical issues, you may be approved for this type of final expense as opposed to another type of policies. So let's look at some advantages, again, for whole life. It's a guaranteed interest, right? Your pay schedule could be, you could pay it off in 10 years, you could pay it off in 20 years. And then once you pay it up, you're done, no more money to pay. Permanent policies are designed to last your entire life. So at least you have peace of mind knowing that whenever you die, there's something that's going to pay out. The disadvantage are the guaranteed interest is very conservative. And if you guys were on any of our previous workshop, we're really, really big on compound interest and getting a high interest, right? But in a whole life, the interest is very, very conservative. So you're not going to get a high interest. This is why even though whole life is good, you guys are learning tonight, there's better options. So the big disadvantage is the interest rate in a whole life is conservative. You're not going to get 10, 12, 15% and none of that stuff, right? And then again, the premium is fixed. What does that mean? If your premium amount is $200 and you want to put more money into that policy to build more cash value, can't do that. You can't do that, right? You absolutely cannot do that. So the death benefit is fixed. So if you started, and this is a really, really not good thing to do, because if you open your policy and you were covered for 100,000, cost of living is going up, right? Inflation is going up. Everything is going up, but your 100,000 is still 100,000 death benefit. What is 100,000 death benefit going to do 30 years from now? That's a drop in the bucket, right? So that's one of the big disadvantages. And guys, you guys will come across clients that are going to have whole life and they're going to have term. That's every day what I see. Whole life and a term, right? And then, of course, accessing the cash value. Let me go back. I went too fast. Okay, so accessing the cash value eliminates the guarantees. So what does that mean? The more money you pull out from your cash value, it's making your death benefit lesser. It's eliminating your guarantees. You have less money that you're taking out. And again, part of that is because the interest in your whole life is conservative. What I've also seen when I examine policies is they may tell you you can take money out of your policy, but guess what? At what interest? At what fees you're paying to access your own money. So they might give you 4% to grow your cash value, but guess what? If you want to pull out 10,000 from that cash value, it's a whopping 6%. Not good, but people don't know these things, right? So when they tell you they got a whole life, get that policy and let's review it. Now, the other type of whole life is called universal. Universal, again, is now you can have flexible premium. So 1 month you could put 200. If you had a great month in your business or you had a great month with your job and you got an extra bonus, you want to dump 500 that month, go ahead. The premium is flexible. COVID came and you lost your job and you can't do 200, go ahead, reduce it, right? The premium is flexible. You can put more and you can decrease, right? So here's an example of a universal, oops, I'm going too fast. A 10-year policy, the person now is age 40. In 20 years, when the person is 50, crazy, right? Really crazy. The policy value, they put in about 34,000. And how much can they outlay? 34. So you're actually breaking even. Your net surrender is about 7,400. Let's say 35 years from now, when you're age 65, your policy value is 22,000 that you can pull out. So it does bill, but again, these are things that for most people, when they have these policies, they're not even paying attention to these because they don't even know what these numbers are, or they don't understand how it could affect their overall finances. Okay, so what are some advantages and disadvantages now with the universal? Right? The advantage is great that we could have flexible premium. Some months you could put more, some months you can reduce. Love that flexibility. You have a flexible death benefit as needs changes, right? Policy and payment can be designed during the life of the contract. So you have flexibility. Now, what about, you could also access the cash. Permanent policy, you could access the cash, and of course, it lasts your entire life. Disadvantage, the guarantee interest, again, tends to be conservative, right? It's conservative, and I don't like the word conservative. You're stifling my money from growing, right? It's conservative, guys. So if you have any one of these, again, get in touch with us so we could really take a look at your policy, see if it's the best that you have for you and if it's really working for you. Because most people buy life insurance with a mindset, oh, I just want some burial money. I want to leave something behind. There's so much more that you can get out of it. Another disadvantage is underfunding the policy could require additional premiums later. So if you put less money in, that's not good, right? So this is a quiz, but in keeping with time, we're going to swim it through. Now we're going to look at another type of whole life. And I almost wanted to say something, but I'm going to hold it back. Let you guys be the judge, okay? Because you've learned all the different types. You've seen the advantages and disadvantages. The last type is called Index Universal Life. Okay. Over the years, pay attention. Over the years, right? So if you have a policy right now that's 20, 30 years ago, girlfriend, boyfriend, I'm telling you, you need to get in touch with us. Because just like your cell phone, which gets upgraded, life insurance also has been upgraded over the years. So over the years, the financial climate as well as people's needs have changed. So Index Universal Life is the most recent policy, and most people don't even know what that is, right? Because these are your most recent updated policies because of the financial climate. People have been losing money in the stock market, right? And the life insurance industry saw that need that people want to invest money, but they don't want to lose money. In 2001 and in 2008, when a lot of people, 401ks and retirement money was wiped out, the life insurance industry saw a need and they created a product that allows people to invest their money and never lose money. So I'm telling y'all better get in touch with us if you have an old policy, okay? Because things have evolved and companies have adapted to these changes. So Index Universal Life Insurance has the flexibility just like a universal, right? Just like a universal, but a cash value that accrues a credited interest based on how the stock market performs. So credited interest to the cash value may have a guarantee minimum rate, which is a floor, and then it has a cap. So what does that mean? If you have a floor, you can never go below the floor. There's no basement here. There's no underground. The floor is zero. For example, you can never, ever lose money. And it may have a cap. Let's say in this case, 12%. The highest you can earn is 12%. And again, depending on how the market performs. Now, it's flexible, which we love. If we had a good year in our business and our job and we want to dump more money, great, we could dump more money. And if we had a horrible year in our business or we lost our job or they cut back our hours and we got to reduce it, no problem. You can reduce it. It is flexible, right? It is super flexible. You could go up, you could go down, right? Now, you can also save in this policy. Right? It's going to build up cash value. You could save additional money in the cash value. So here's a illustration of a 30-year-old female, right? 30-year-old female saving about $6,000 a year, right? $6,000 a year. Now you may say $6,000 sound a lot, but guess what? A Roth, the maximum Uncle Sam or IRS gives you, I believe, is $6,500, right? So let's say you have $6,000 a year. If you were to put this $6,000, save it in a 401k, save it in a Roth, save it in an IRA, that's all you have, $6,000. But if you put that $6,000 in an Index Universal Life, now in addition to that $6,000, you have $500,000 coverage. Guys, understand the power of saving money in the right vehicle. You put $6,000 every year in your 401k or your IRA or your 403b or your Roth, and if you die, all your family is going to get is what's the value of that 401k, 403b, IRA, Roth, or whatever. But if you put that same 6,000 in an index universal life and you die the same year, your family gets over $500,000. Come on, people. Y'all need to wake up. If you don't have one of these, get in touch with us because y'all are dropping major coins and your kids are not going to have any generational wealth. Right? And again, these are your most newest policies. This is why a lot of people never even heard of it. Right? Now, let's look at age 50, 20 years into this policy. You paid in $120,000 over a 20-year period by you just saving $6,000 every year. $6,000 every year. So in a 20-year span, when you're 50, now retirement age, you paid in 120 and you can access 165. You're taking out more than you put in. And you still got more than $500,000 in death benefit. How amazing. Now, had you put that in the bank, you would have had $120,000. That's it, right? Because we know the bank don't grow our money. The bank does not grow your money. The bank does not grow your money. What is the interest? 0.0? Are you kidding me, people? Okay. Age 65. Now you're ready to retire. Look at the numbers, people. You're 65 years old. You paid into this policy or you contributed or you saved $210,000 in a 35-year period. Holy moly. You paid in $210,000 over 35 years, which is $6,000 a month. Follow the money, people. I'm getting excited like if it's my money. Let me calm down, okay? Let me calm down. This is just a presentation of data. This is not your money. It's a presentation, okay? 65, 35 years in, you paid in or you contributed or you saved $210,000. And how much can you touch? Follow the money, people. Follow the money. Your cash surrender, which means this is money that you can touch. Guys, this is your retirement money. More than $500,000. And the best part, this is tax-free money. What is tax-free money? Tax-free money means more money, period. Because if you had $517,000 in your 401k, that is not tax-free. If you had $517,000 in an IRA, that is not tax-free. On top of it, stay with me, people. You got over $1 million in death benefit. How is your long-term care looking? How is your life insurance? How is your kids and your grandkids looking now? Now, had you had this money in a 401k, 403b, IRA, any one of those vehicles, you ain't ever getting $1 million death benefit. Now, what if you live longer? You see, that's the thing. What if you live longer? Because we don't know. Modern medicine can do this in a couple of years. What if you live longer? Guys, and I'm going to go back to this chart. What if you live to age 115? Guys, you may not live to 115, but like I tell people all the time, I'm going to die rich. I'm going to die rich. My nieces and nephew kids are going to know about Auntie Odetta, right? That's how you got to be thinking. But if you got a basic ass policy, if you got a basic ass whole life, or if you got a basic ass term, you better die within the term. If you have a term, you better not die within the term. That's the only way your family is going to see that money. Or if you got a whole life and you had 100,000 coverage, hey, 30, 40, 50, 60 years from now, what is 100,000 going to do? Not much, guys. Not much. We are super passionate about sharing this information. It is a super big deal. It is a life-changing opportunity. This is a money strategy that's not only set up for you to win, but for your unborn generational to win. Right? Over $1 million, right? couple of $1,000,000. Now, if you live until age 115 and you die, come on, you're leaving $6 million. Okay? They gonna have your picture in their wallet. They're gonna be singing you praises while you're in the grave. Now, let's talk about the advantages, because everything has advantages and disadvantages. The advantage, your credited interest has the ability to rise, which is good, right? So you could get 12%, 15%, whichever contract you have, you could get that growth. You have the flexibility. You want to put more money, you want to decrease your money. That's all good too. You could go up, you could go down. Things are not good one year, you could decrease it. Things are awesome one year, you could dump 100,000 in there, right? Then you have the flexible debt benefit, right? So your debt benefit could keep rising, or you could have a level debt benefit. The policy and payment can be designed during the life of the contract. Permanent policy designed to last your entire life, y'all. Check your whole life. Most whole life covered you up until age 100. So boo-boo. What if modern medicine and technology now has us living until age 103? You're asked out with your whole life. Because they only cover you until 100. So you better die by 100. But what if you're blessed with good health to live 102? Guys, you gotta have strategies that's going to do the impossible, even though you may not see it right now, right? And you can access that money, right? You can start cashing out when you're ready to retire, or your kids getting married. You could pull out 20, 30, 40, 50 grand. Bless your kids with a nice wedding. Bless them with a nice house down payment. You could touch your money, baby, right? So this is not a debt policy that you just have, and then it's like, oh my God, I'm never going to see this money. When I die, my freaking kids are going to get it. No, you're going to get it first, right? The disadvantage, right, because everything has disadvantage, if you underfund your policy, it's going to require additional premiums later. So these policies are not designed for you to put the minimum or basic. They're designed for you to stack away, dump more money you put in, more money you take out. This is not your itty bitty policy where you're just like struggling to put 100 or 200. No, maybe you struggle in the beginning, because my first policy, I was paying $160. Once I fully understand this machine, this beast that could not only set me free, but my unborn kids free, I started stacking away in here. You know, if I had a great month, I'm not putting it in Bank of America, Chase City Bank. I'm stacking it over here. Why? Because over here, I'm getting a higher interest, right? So this is the type of policy you want to overfund it, not underfund, right? That's really the disadvantage. One disadvantage. You got to feed that beast. You got to feed it, right? So, oh my God, there's additional riders, right? You can add on additional stuff, just like cars. You could, put some gadgets on your car. With these type of policies, you could put additional riders on it. You could insure somebody else. You could insure, you could have a waiver of premium. If you lost a job and you can't make any payment, you could have a waiver of premium. And you could have long-term care. Now, I'm going to stick on long-term care because, listen, we have a doctor in the house that is part of our financial campaign. Shout out to Daniel Fumbo. Kudos to you. We applaud you. We love you. We thank you for bringing your knowledge of the medical industry into our financial campaign. And some of us were privileged enough to be part of his special training. And he's going to talk about really finance, but with an impact on how health and wealth goes together. Because as a doctor, right, if you Google the number one disease, most people are going to get sick before they die. Most people are going to have some kind of chronic or critical case. Statistics shows every 7 to 10 seconds, guys, Google this stuff. Every 7 to 10 seconds, someone is being diagnosed with heart attack, cancer, stroke. And that's the number one reason why people go bankrupt, medical expense. So if you have a long-term care, you got extra peace of mind, extra protection that, God forbid, knock on wood, if my health goes south, at least my mortgage is still going to be covered. My kids still going to be in the room. The bills are still going to get paid, and I can focus on getting better as opposed to also stressing about money, right? Long-term care is not a matter of, should I get it? You need it. Everybody need it because we're human beings. Things are going to break down. We're going to get sick, right? We're going to get sick. We need it. We absolutely need long-term care, right? It's not a matter of if, it's a matter of when. And even if you're young and you're healthy, what happens when you're 90s and 80s? You're going to need it, right? You don't want to be going to Kings County nursing facility. Are you kidding me? What kind of help is that, right? Take a walk over there and see how they treat these people who got Medicaid stuff. Long-term care is like your black card. It's like your American Express for your health, right? Because you can also add chronic and critical illness. Guys, these living benefits, you may not need it right now. Maybe you never ever need it, but I'd rather have it just in case. It's like I had a condo, I had a pool, and I can't even swim, but I don't care. I got a pool, right? Let me have it. I could go take swimming class. I could learn to swim, but let me have it. So I don't know if I'm going to ever need it, but I want to have it. I need my long-term care, and stacked up with my long-term care, I'm stacked up with my critical chronic. God forbid anything happen, I got it. And I'm going to give you guys a true story. We had a business partner who never got this type of policy. She didn't have a long-term care. She got hit with cancer. Unfortunately, I remember having a conversation with her trying to raise money to go see alternative treatment. Because guys, your health insurance is not going to cover certain things. So if you want to try alternative, or you want to go to a special place or try a special treatment, they may not take your health insurance. But guess what? If you got your long-term care, that is your money, honey. Money is good. They'll take it, right? So these are extra things that can be added to policies, and not every companies have these riders too. This is why when somebody tell you, I got a policy, you need to say, great, let me see it. Look for these things in the policy. If they don't have long-term care, in my opinion, that is not a good policy. If they don't have critical and chronic, and depending on how much they're going to pay out, that is not a good policy. Okay? No, we're not playing with our health. We need health and wealth, right? Health and wealth. You also want to have, if you can, accelerated death benefit, right? Accidental, that's just to throw in, but that's really not a good value because, listen, you never want to limit yourself to die a certain way. Why are you going to get accidental death? Did God tell you you're going to die by accident? No, it's too rigid, right? More benefits. They are tax advantage to life insurance. And this is why rich people buy life insurance. Everything that I just said is great, but if you really want to win the money game, the tax advantages, this is why they don't buy itty bitty small policies. They buy big policies so they can dump more money in these policies. Tax advantages, right? It's tax-free money. Guys, tax-free money is more money. Tax-free money to your beneficiaries. So if you die and you leave $3 million, that's $3 million that Uncle Sam cannot get a penny from, right? It's tax-free long-term care. It's tax-deferred growth on the cash value, right? It's income tax-free money that you can access in the policy. Listen, this is the next level stuff that white people and rich people and people who really understand this money game, this is why they buy life insurance, to get these tax benefit, to dump a whole bunch of money in here and Uncle Sam can't tell them nothing. This is how you hide the money. Funny enough, I was talking to a client on my way driving home tonight, and he was telling me, I'm doing really well, but I got to hide some of this money. And I'm like, no, I got you. Let's set up a one-on-one. I got you, right? Hide the money. Then you could have tax-free withdrawals. Guys, just the word tax-free is awesome. Uncle Sam don't like that word, but we love this word, tax-free, right? If the policy is canceled, of course, you're going to be subject to taxes. That's why you never, ever, ever want to cancel these type of policies. Because if you have to cancel it, you're losing all the benefit. Now you're gonna have to pay money on that tax. So when people tell me, "Oh, I'm gonna stop paying up until a certain time," or I'll cancel it and close. I'm like, girl, no, you're not canceling, you're not closing nothing, because you don't know how this stuff works. You're not canceling, you're not closing, because if you do that, you're losing all the tax benefits, right? You don't cancel IUL, honey. You keep it, right? So you can have insurance for others by ensuring you can insure your kids, right? Make sure your kids are also covered, right? Many of us don't want to think about our kids getting sick, right? It shouldn't be. But why not protect your kids, right? Protect your home, right? If you're a mom and you have a mortgage and something happened to you, now your kids are going to be forced out of the house to go live with somebody else, right? Single people also need life insurance. I never thought I needed. Single people, do you care for your parents? Do you plan on having a family in the future, right? Again, get it while you're young. Get it while you're young. Lock it in, right? Every time I see somebody with a child, I'm like, you don't even know that's a millionaire baby you got there. That's a millionaire kid, right? The younger these kids are, lock them in. Make them millionaires. Insure them. Start saving for them, right? Uninsurable. Hey, because if you don't do it, we don't know what could happen next year, next month, next 5 years. We could become uninsurable. We could have health issues. There's no guarantee, right? So get it while you can, while you're young, while you're healthy. Insure everybody. Everybody's stacked up, right? And everybody's winning the money game. Everybody's winning the money game. So now that you know better, or if you're still confused, right? This is where, should I buy term and save the difference? Some people like Susie Orman and what's the other guy? I forgot his name. Dave Ramsey. They believe in buy term and invest the difference. But the problem with that, and let's talk about the problem. Some people say, should I buy term and save the difference? Some people ask, why bother with cash value life insurance when I could buy a term for a lot of coverage, little money, and I'm going to save the difference? Okay, but how many are really saving the difference? And do you know how to save, grow, and protect the difference? Right? So a whole life might be $1,000 per year. You could buy a term for $200 per year and save $800. Yeah, but are you going to save the $800? Are you going to be disciplined to know what to do and be consistent to save the difference? Most of us are not going to be consistent. Most of us don't even know how to save and grow the difference. We just don't. We're not going to be consistent. We're going to spend the money. We're not going to save it, right? And even if we save it, we're not going to know the best strategies to grow it, right? We're not. We're just not. We're not going to know it. Now, many ads promote low-cost insurance. Sometimes I have people telling me, oh, I could go to XYZ company that they saw something on the internet or on TV. They saw an ad, that's pushing low-cost life insurance. As you know now, they're probably selling term insurance or they're selling a basic policy, right? But if people don't know better, they're going to run for it. And this is why we do these workshops every Wednesday. Is it okay to buy your insurance online? You can if you know what you're doing, right? However, it at a cost of having your financial professional on your side. Remember, these companies that you're going to see, very few of them have all the different types. So if you go to one company and they're only selling one type of policy, That's what they're going to shove down everybody's throat. The good thing with our company is we can sell all the different types, right? All the different types. And when we show clients all the different types, then you can make the educated decision now that you know the pros and cons, which one you want when you understand. So, FAQs, doesn't my life insurance through work cover me? I get a lot of people who still think they're good with their job insurance. They're super good with their job insurance. Your employer may provide this benefit, however, may not allow you to take it when you leave. And I kid you not, it hurts, it hurts, it hurts. Maybe this is why I'm so pushy, I'm so aggressive, because I hate when you're 80-year-old and you're calling me now to tell me I'm no longer with the Rockefeller Center, or I'm no longer with JP Morgan Chase, and I'm no longer covered. Are you kidding me? You're 80 years old. Do you know how much it's going to cost you now? Right? It may not go with you. Guys, anything to do with the job, please do not marry it and think you're good. Because the job can change their decision. They could pull it. They could say whatever they want to say. And you ain't got no say in it. It's theirs. Right? Why is it so cheap? Or why is it so costly? As we've learned, there's many different factors. It goes by your age, it goes by your health, it goes by your gender, it goes by how risky you are. There's a lot of things that these companies are looking for. This is why I tell everybody, you're young, you're healthy, you ain't got nothing crazy going on, lock it in. Lock it in. Lock it in, people, right? Do you think your health will change as you get older? We don't know, but most likely it will. We're human beings. Things are going to start breaking down. Right? Like right now I'm popping these allergy pills. Like where did this come from 20 years ago? Right? Now I got to be popping allergy pills. Ridiculous. So things will change with our health. And do you have a strategy that's going to address your responsibilities? Maybe 20 years ago you didn't have no kids. You didn't have a mortgage. You didn't have a husband. Right? So things change as time go by. And do you want the benefits that may help with your overall financial strategy? Life insurance is not just about debt. So many people buy life insurance and they just say, okay, I want a policy to help bury me or just leave some money behind. It is so much more. And this is why people have a negative connotation, because they feel like they're not getting anything out of it. They're just paying for it. And when they die, somebody's going to get the money. But life insurance, if you understand, it's part of your total overall financial wealth. So, will you be self-insured during your retirement years? Hey, we cannot bank on the government. First of all, the government is broke. So please don't tell me about the government. Please don't depend on the government. Please don't depend on your job. You have things in place that's going to help your retirement years. And if you're self-employed, you better get in touch with us, because you ain't got nothing to get. You got to fund your own retirement, right? Well, you need to consider estate tax. Some of us may own homes. But guess what? If we still got a mortgage on that house and we die, our kids may not be able to take over that mortgage. So guess what? The bank is going to swoop it up, right? Do you want to pass on wealth? Everybody wants to pass down wealth. Of course. My mama ain't got nothing, but she'd love to leave Zay something. She'd love to leave Corey something. Do you want to pass down wealth? Everybody want to pass down wealth. Even if they hate their kids, they may love their grandkids. Everybody want to pass down something, right? So get the right type of policies. What is best for you, right? You may not know. You think you have something, you think it's the best. Get in touch with us. Let us do a free complimentary policy review and show you side by side, and then you make the choice, right? You make the choice. And I think we are almost done, right? Get in touch with the person who invited you. For those of you that are partners with us, your next step, if you're not licensed yet, as we always say, get that license. No license, no money. You came here to help families. You came here to learn about finance. But if you ain't got no license, you can't help nobody. You can't even talk to people if you ain't got no license, because you can't help them, right? So get your license. Set your exam date. If you don't have an exam date, set one. We have boot camp coming up. I think it's November 7th and the 14th. Get on those boot camps, study by yourself, get on those boot camp, and go pass your license. Start making money, start helping families, get out in the field. This is how you're really gonna learn this stuff. Not only by coming to the Zoom, but sitting down kneecap to kneecap, or well, not kneecap anymore, Zoom to Zoom, right? Sitting down on a Zoom to Zoom and sharing this information with families, seeing how powerful this information is, because most people do not know. I didn't know it, right? Most people don't even know it. So guys, I know we went over a lot. So please get in touch with the person who invited you, and so we could have a one-on-one and share this information to help you for your specific need. And with that being said, next Wednesday we'll be back here again. Thank you guys so much. Have a great night. And you guys that are on Facebook, woo woo! Make sure you get in touch with us to share this information with you. We could do a complimentary free policy review to help you with your own finance. Thank you guys for watching. Share this video. Share it with everyone you know, because everybody needs this information. Thank you so much, guys.